you, everyone, and good afternoon, everyone. Welcome to our last panel of the day, our Urban Intensification panel. With us today is Michel Leonard, CEO of BTB REIT, Toby Chu, CEO of CIBT Education Group, and Mr. Michael Cooper, Portfolio Manager of Dream Impact Trust. I don't think there's much of an argument in our urban landscapes in Canada. We need to increase density. We need to have more efficient usage. Michel, you recently established an action plan in regards to air rights opportunities. Can you expand on how this opportunity came along and your views on the project at this stage?
Well, we have a number of similar projects that we can deploy within our portfolio, but this one specifically has to do with a necessity-based shopping center, not an enclosed mall, where we have what I call an ocean of parking or an ocean of asphalt that is basically used under the old guidance of 5.5 parking spot per 1,000 square feet leased by the different retail tenancies. And so obviously a little bit too much. And there's a fact where cities, obviously for revenue, would like to densify sites. And so we're hand in hand with that city in order to densify the site. So that resulted in a sale, a conditional sale based on the zoning requirements for the residential developer. But we sold our air rights for $30 million and could be more, depending on the number of units that the developer could sell on this property. So we hear a lot about the urban sprawling and the fact that the core cities want to basically stop the urban sprawl in the sense where they're losing a lot of revenue as a result of it. So I find them more and more amenable to look at redevelopment of existing sites on that basis.
Perfect. And on a different scale, Michael, I don't think anyone in the country is doing the level of intensification that Dream Impact is undertaking. Can you expand on some of your projects? I find they're just so interesting. And then is there an underlying cross-market thesis that really drives the development?
Right now, it's a really hard time to sort of know where we're at for a lot of reasons. But what we've been doing is we've been doing a lot of public-private partnerships to build affordable housing as part of mixed use. So we got about a $1.4 billion project that we funded with CMHC. We got low-cost debt for 10 years. The first of 3 large buildings will be opening at the end of this year, beginning of next year. And the Ontario government was very generous in terms of taking the value of their land and really transferring it to help us make a discount for some of the owners. So altogether, we're building about 2,600 affordable housing units. That's out of about 7,000 or 8,000 units in total. The discounted rent on those units are 43% from market, and the residents will save $42 million from market. So, something like that is very exciting, and you get it all lined up with the debt and land, and it's pretty wonderful. We're doing an Indigenous hub where a First Nations group owns some land downtown, and they want to have a health center that's both Western and traditional medicine, a business incubator, education center, daycare, and some other facilities. So to fund that, we bought some land for condos, and we leased some land to build apartments and an event center. So we'll be able to help them pay for their building as well as provide them some annual payments for their programming. We've got a project in Port Credit where we bought the Texaco refinery, which damaged land environmentally, and we've cleaned that and turned it into an award-winning community. So, we won Quayside this year, which is a massive project. It's still very early stage. It could take a long time to put the pieces together. But the stuff that we've been doing is turning out great. Right now, we've got interest rates have more than doubled. The unions have just settled, increased wages that'll add prices. We don't know where the commodities are at, like steel. Wood's come down, but steel and a lot of things are still high. Fuel's high. And the levies in Toronto, the city's proposing to increase them by 50%, and 50% to about $225 a square foot is a city levy. And the park levies, they propose to go up 150%. So what we're seeing right now is the projects that we started, they're going great. And the projects we have in the pipeline, there really isn't good data to use now for what the interest rate might be, what the revenue might be. So it's a pretty unusual time. One piece of news that I thought was really quite interesting is that just in the last 3 months, we've seen between 4 and 7% increases in apartment rents in our portfolio. So, we're just sort of looking through everything and trying to put together a thesis for what comes next. We are seeing rental growth in the apartments, which is great, but the interest rates and extra costs are really making it difficult on projects we haven't started yet. But the ones that have started, we expect to get mid to high teen returns on a reasonable amount of capital for a very long period of time. So we're pretty excited about that.
Wonderful. And Toby, in the Canadian public sphere, you're unique in the fact that you build student housing. It's such a massive asset class in so many other markets, and it's something that's been difficult on the public side in Canada. Can you talk about how you're driving efficient housing in such a tight market like Vancouver?
Yeah, Vancouver's supply obviously is a lot lower than the demand. And in the recent month and years, there's been a lot of reports on new immigrations, migrations, international students. Those all increased quite substantially, which drove the Vancouver rental market to a pretty much sky high. I saw a news release by the government that the rental rate has gone up by about 29% year-to-year comparison to the previous year. So that's a substantial increase for rental rate. In our our part of the world, we have some unique operations whereby we combine our education entities income with the rental income. So we are not so much governed by the 2.75% imposed by the rental control. So we are lucky in that sense. So far the market in the Vancouver area has been quite substantial in terms of growth, despite the cost of construction, financing costs, etc. Rental rates just keep going up, and we are able to continue adjusting our rent on a quarterly basis as new student flows come in. So we've been lucky in that sense.
Fantastic. And it's one of the things actually we talked about earlier today in the multifamily is looking at repurposing underutilized assets. And I know, Toby, that's something that you've done before. Can you talk to this? And, is there future plans to do it again? And what are your thoughts around that?
Yeah, we've done a few conversions, but obviously, I don't know about the other part of Canada, but in BC, in most of the municipalities within the Lower Mainland, it's been very political when it comes to rezoning, and all of the planning department are extremely busy. Especially with 2 years of delay of their work. So the time delay has been substantial, causing a lot of unpleasant surprises when it comes to rezoning. So yeah, at this point, we are not doing a lot of refurnishing, retrofitting, but definitely once it's done, the properties are taken up right away. But the cost of construction, cost of delays, particularly when it comes to rezoning, a big issue here in the city, not just Vancouver, but all the neighboring municipalities. And you can easily see a 5 to 7 years delay from rezoning to possession. So that's a long time to build, a project. But that's just a reality we have to live with.
That's expensive.
Yeah.
Michael, on both the Impact Trust side as well as ones like Dream Office, you've looked obviously in the same way to intensify existing assets. Looking at the time, as Toby just said, to rezone sometimes, or just the amount of work to tear down to turn into brownfield. Is it better to intensify an existing asset, or is it recycle a brownfield asset that maybe is more denser and efficient afterwards, but you've got that whole kind of those steps in between?
It's asset by asset. What we like to do is own an asset that produces some income. So maybe we have an office building that produces a 4.5% yield or 5% yield on our costs. And that gives us lots of time to deal with the city. Effectively, what you want to have a decent yield on your asset, and you want to have as little improvements. So we've got a couple of sites that are big pieces of land with small assets. So those ones we're really happy to spend the time rezoning, and then we'll tear them down and build something new. And those work out great. what the big trend in Ontario is that every level of government, including the federal government, is looking at underutilized lands and trying to figure out how to use that to create affordable housing. And I mentioned earlier that they'll discount the land if we commit to providing cheaper rents to tenants. So literally since 2017, we've hardly bought any new land other than through processes with the government. And we spent a lot of time on our own lands getting it approved. I think Toby's totally correct. 5 years getting a piece of land rezoned is probably reasonable. That's just how long it takes. In Toronto, I didn't know about Vancouver. So you gotta, I mean, so it's just great if you got income in place. If you buy a piece of dirt, it's a little bit more difficult because you have no income. But you know, we do the deals with the city. Usually we don't close until we're pretty close to having them zoned. So there's some advantages there. But it's a really exciting, creative process. And the key thing about it is trying to get all the variables locked up at a time when you make a big decision and lock in great returns. If it goes against you, you have to delay. So this is a pretty interesting time to figure out. But what I would say that Toby mentioned, I think Michel also mentioned it, the revenue side seems to be in pretty good shape on everything we do. So if you can get it built, there's a really good chance you're going to get a good income out of it. Just got to make sure the costs and everything else falls in line okay.
In Montreal, our time to get the rezoning is a lot shorter. We're talking about 18 months. We have a project in Ottawa where we're looking at rezoning, and it's more like 36 months. So on our front, it's a little bit shorter as far as the delays are concerned.
And that's more on, you know, kind of rezoning onto a new site. You know, there has been, certainly in Toronto, where you have existing assets that are functional assets. You know, none of you own, but like a 480 University, it was a good quality B-class functioning office building that managed to put, you know, pretty significant. It was condo, but you know, I think at this point rental would work as well in some cases. Is that something that you're looking at? That's something that you think is feasibly easier with the city to just, you know, add on that additional density?
If you don't mind, I think that's 488 University. No, I'm not sure what number it is. It's around 485. It's across the street from one of our buildings. That building was set back a little bit. And the way they constructed was they created a new structure, a steel structure to support the 27 stories above the 18-story building. That was only feasible because the building didn't actually go to the property line. It's amazing that they built that one. There's not a lot of other opportunities. We've looked at it a lot of places. Literally building a structure like that in a building that isn't as set back can cost more than the actual land costs if you buy a parking lot. So that was very unusual. As far as the rezonings go, I don't think that makes much of a difference. And you know, we can spend a year and a half after the zoning to get the site plan approved. So and we're also involved in Ottawa and a lot of places. Ottawa is not bad. We find them very productive. And in Western Canada, it's unbelievably more difficult than it was a few years ago. It's still not as bad as Toronto. But it's just amazing how much input there is from the cities and how many layers of additional approvals there have become.
Michel, you know, you've talked about the one air rights, but you do have a lot of assets that are, you know, fairly light in terms of coverage. Do you give up those assets to get new square footage afterwards on a new development? You know, you've got some degree of retail or retail pad or something. Let somebody else build, take the retail or the couple floors of retail and office that go underneath it as your development return. Is that something that you'd look at doing?
It's a mixed bag of things. We have a site on the south shore of Montreal where I mean the site, you know, again, an ocean of asphalt, but it's somewhat well utilized. But we're looking at basically tearing down part of the center and building, keeping part of it and then developing the rest of the site. So it's really a mixed bag. You have to look at every site, and you know, sometimes your nose, your experience tells you exactly what should be. So you look at the site and you say, okay, this part we can keep, and then Then the rest we're going to demolish and basically build something totally different. It could be an office building, especially in this area. Our main tenant on this site is a city, and the city has voiced the fact that they want to bring all their different office components together. So we could basically do it on that site. So it really is putting the ear to the ground and just figuring it out. So it's not, so every site you have to look differently and with a different eye, and you have to look at your tenancy as well, because at certain sites we have the who's of retailers, and we certainly don't want to upset them. In the first instance that I mentioned, we have a food retailer that's well known, and they have basically a no-build zone on the whole site. So we had to approach this merchant and basically discuss the densification of the site with them, and you could probably surmise that the first thing that they say is, how much are you going to pay us for, to lift the no-build zone? So we ended up not paying anything. We're quite happy with this, but overall, it's site by site, and it's a lot of studies. As Michael mentioned, it's not something that you look at, and you try to just basically do a blanket coverage of every site and say, we're going to do this with all our sites. It's just impossible. Every site's got its own history, its own development potential, its own environment. And it becomes really, it's challenging, but it's a fun challenge. So and you embark on this challenge and you say, I am going to do this. Then you get through all the hurdles, the 8 years wait in order to get to your development and so on. And the carrying costs and the this and the that, and then eventually it gets done. So, and that's the reward, because the reward is to have a vision, make sure that the vision speaks to the environment, the community, and if it does, it's going to work. If it doesn't, then hopefully it does. It does. So it's it's negotiation after negotiation for everybody, whether it's a traffic study, a sewer study. I mean, a lot of people become rich as a result of doing all these studies throughout this process, because the cities are just asking, right? They're just saying, I want this, I want that, show me this, show me that. So it's like a never-ending prophecy as far as the professionals that you have to hire, the studies, this on which you basically make your representations to the city. It used to be that parking ratios, as I mentioned, was 5.5 per thousand, and is 5.5 per thousand the right amount of parking spaces today? Is it 3 per thousand? Is 2.5 per thousand? If you're linked with a light speed train and so on, are you still sure that your ratio is right? Because obviously, the lower your ratio of parking, the more you can build onto the site. So everything is sort of, it works together and creates its own sort of environment. Do you want to push too high? So if you want to push too high density, then all of a sudden you're going to, instead of 8 years, could be 10, but maybe you're going to get it. So it's all the give and take that does take place in order to figure out what the right thing is. And real estate is something that is going to endure time. So what we decide today is still going to be there in 50 years and 100 years. So you better do it right. So it's like there's a lot of weight on the developer's shoulders in order to get it right, to get the right architecture, to make it that it's going to be lasting. And I'm not talking about a tribute to BTB or to Dream and so on. That's not what I'm talking about. I'm talking about this to make sure that it's going to be lasting and it's not going to be an atrocity in the market.
Absolutely. And I think, a lot of this comes down to, and, you're all fantastic, great developers that do build things that last and want to be. But at the end of the day, we're, the three of you are public companies, and you have to look at, at the end of you're building into tight markets. So, Toby, starting first, what are your views on development costs, your expected yields, your financing costs? What are you building to, and what do you expect you need to build to?
Obviously, development costs are going up everywhere, we all know, and it's not going to coming down anytime soon. But surprisingly, I did get a few calls in the last few weeks that subtrades are looking for work. I haven't got that kind of call for a long time. I think partly because everybody put their projects on hold. So now all of a sudden the subtrades are looking for work. Raw materials not coming down, obviously, for inflations and all that. So that side of things, and the interest rate is not going to move anywhere. So in terms of our business plan to oversee this kind of problem is really focusing on the internal operations. We do have a full infrastructure of operations to cover the student rental and rental to professionals. So we have our own social media marketing, our own internal team for booking, reservations, et cetera, et cetera. So, and even housekeeping. So with all those in place, we're able to overcome the internal control of costs instead of fighting the external, which is basically is fruitless to try to control the cost. And again, on the fortunate side is that the higher the cost to us, the higher the rent is going to reflect to the tenant. It's just the way it is. And unlike other pre-sale condo developers, we don't have to face the pre-sold rate of the condo with the margin pressure that we end up facing. So far, we continue to maintain an ROI of 20% on our projects, about 13 to 15% on the NOI, and 7 to 8% net per year, partly because the rental rates just keep going up, as I mentioned earlier. So this model has been keeping us quite well, and we're able to control, because of the economy of scale, we're able to maintain all of our internal infrastructure costs relatively low by increasing our portfolio. So yeah, it's a self-sufficient operations as compared to pre-sale, and we are fortunate in that sense. So and our ongoing objective is to control the internal factors while we cannot control the external factors.
Wonderful. And Michael, you've got a obviously massive development pipeline. Can you speak to some of the same development costs and yields, and then we'll touch on ESG in a minute, but just, in terms of financing, you've talked already a little bit about being able to work with CMHC and that sort of thing. Are you finding on the intensification projects that you're able to get a different type of financing than you would on a greenfield development?
Yeah, 100%. We work on, we try to achieve a lot of environmental goals as well as affordable housing goals and inclusion goals. We often get, what we try to do is get somewhat higher leverage, lower cost interest rate, and longer amortization. And that allows us to provide a lot of benefits to the community. Generally we've been building at 4.5%, and we've had, on average 1.6% 10-year fixed rate debt. So there's been lots of room to make money on that. There's not a single number that we would have used last year that you could use this year. So, we're just looking at a lot of different variables. But I think that, I think Toby said it, we don't expect costs to go down. Levies are going up, interest rates are going up. New products going to be more expensive. There's just no way to do it for less money. There's 400,000 people coming to Canada, and there will not be enough homes. So whatever homes are, whether it's student housing, if it's condos, townhouses, apartments, single family homes, there won't be enough. So there'll be a lot of pressure. And I think what Toby was just mentioning, that he's hearing from some trades that they're not as busy because maybe some projects are on hold. That's really reducing supply. Every level of government is talking about increasing supply. And in 2022, we're looking at actually having supply decrease. So there's a lot of things playing out. We've got a lot of excitement on Thursday. Frank Gary's coming up from LA. He was born in Toronto. We're launching a project of 800 units, about $1 billion in revenue. And it's by far the highest rent per square price per square foot. It's a beautiful building. Architecturally, it's stunning. It's significant because Frank Gary's 93, and this is his only building from scratch in Toronto. So I think it's going to be, as Michael was saying, Michel was saying, a building that matters over time. We could skunk it and not do very well, or we could have a huge showing. It's very specific to that one building, but it's very exciting. We're going to have 750 come out to the presentation by Frank Gary. We're taking orders immediately thereafterwards. We're going to get a lot more information on Thursday and through to the next week than we've had in the last few months. So I think it's going to be a real bellwether as to what's going on. But if we can get that project successful, we've been working very closely with the trades. We've got about 50% of the costs fixed. So if we can line that up, that'll be an amazing coup in this kind of market and really show that if you build something important, people will support it.
The only thing I wonder, Michael, is how come I wasn't nor Toby were invited?
Do you have your license?
What kind of price per square foot are you looking for those condos?
In and around 2,000 a square foot.
That's why we're not invited.
Exactly.
You'll be on the friends and family list.
Michael has been watching our stock price and he said you can't afford it anymore.
Yeah, we're dealing with people whose businesses are in the private markets.
But that is an iconic building. I think that's one of the most interesting things is nowadays the only places to build iconic buildings are going to be on brownfield development sites. That infill, you're not, what you're doing, Michael, in Port Credit. I mean, that's a brownfield development. In a lot of ways, it's so large, it also almost becomes, greenfield because it's brand new to the world. It's been off by itself for so long, but it's, to really build something like what, you're doing with Gary is going to be really, you couldn't put that up in Vaughan.
Just to pick up one point. Sorry, Michael, go ahead, Michel.
I was saying that it starts with great architecture and it's something that lasts. You build it ugly or you build it nice, it's the same price. It's no different. You just have to build it nice.
So what we're finding is there's a lot of people who don't buy stocks. They've been buying condos for the last 15 years, maybe one condo a year. And 15 years ago, they bought it at $500 a square foot, and now it's worth $1,300 a square foot. They made a lot of money. The next year, they bought another one. They're cash flowing, they paid down debt. So, we bumped into people with 15 to 20 condos, and they probably have on average 25 or 30% debt. They got cash flow. And these guys are making a great living without buying stocks. It's just a different way to invest. And a lot of people who have their own businesses aren't comfortable with the stock market. And it's turned into a great business. A lot of times over the last number of years, when we do the pre-sales, the guy who buys it, they make more money on the unit than we do building. So there's a lot of loyalty from people making, meaningful money for their families by buying condos every year.
Do you worry though? I mean, and this is almost getting into the multifamily panel, but do you worry about the liquidity of people like that? It's, as you say, as time goes on, their LTV continues to go down, but those are illiquid assets, and you buy cap REIT, you buy InterRent, and something happens, you can sell it that afternoon.
It's yeah, but if you want to sell this afternoon, you're going to do worse than selling a condo. So you can only do it on a good afternoon. It's just a different group of people, and they've got a lot of cash flow. They're very sophisticated. It's just a different group of investors, just like you find institutional investors and retail investors doing private equity. It's just a different way of investing your money, and it's been very successful too.
And Toby, I think you almost see some of that. You've had assets that were student housing that performed fantastically well, student housing, and you've had traditional multifamily real estate investors come to you and buy it at fantastic prices, but they're turning that back into a traditional rental apartment.
Yeah, they did. I don't think they are turning it back into traditional rental apartment because they want a lower income, but I think that's what's in their wheelhouse. For example, recently we were working with a insurance group from Toronto, and their mandate has to be rental. So even though we are generating about 30% higher in rental income for them after possession, they couldn't do it because their mandate, it's just going to be a rental apartment. So it's not so much of what they don't want it, but it's just the charter disallowed them to go into an area outside of their playing field.
And one of the things we did talk on just a few minutes ago, and I think it's something certainly near and dear to all three of your hearts, but Michael, you've been probably one of the most vocal in the country, and Dream has certainly been one of the leaders, is the ESG space. So can you just talk a little bit how we should kind of establish and create KPIs for ESG in the real estate sector. It's something new. It's something that we've always seems like we're a little bit behind Europe, and Europe's been the leader in, but it's something that's going to become increasingly important, and every investor on the public side is going to have those check marks. So what should they be looking at, and what are your thoughts around it?
I mean, it's such a big topic. What I would say is ESG is kind of becoming a bad word. It's not really clear exactly what it is. I mean, I keep reading reports about some of the leading financial organizations in the world having trouble with regulators because they promised ESG. When the war broke out in Russia, all of the mutual funds in total had 2% exposure to Russia, but the ESG funds had 5% exposure to Russia, mostly in oil. So it's an odd thing. We really focus on impact. What we like about impact is we're not looking at the negative things within our portfolio, like the risk to our business. We look at what we create. So as I said earlier, we create a lot of affordable housing that influences a lot of people. 20% of all the money we spend, we try to spend on local and underrepresented on businesses that are owned by underrepresented groups, and try to help them grow their businesses. We're building $6 billion worth of net zero communities. So we're developing our skills in that area. If you start with net zero, it's going to be net zero forever. And we're putting together utilities to support that. And we're just trying to figure out how to make more glue for people to feel like they belong when they're in our communities. But we really do focus on how to enhance people's lives while we work with governments to achieve their goals, as well as all of our stakeholders.
Now, Michel, I know you've got some fairly strong metrics and goals in that space as well. Could you talk to that?
Well, we've started a few years ago not knowing what we were doing, basically, but it turns out that all of a sudden becomes a good fad. But I mean, for us, we started as a simple thing was protecting the bees, and we called them the BTBs. So it was basically we put bees on top of our office buildings and so on, and all of a sudden it mushroomed into something else that was fantastic. And that was not my initiative. It was one of our employees that said, listen, we have to protect the bee population, and we started this way. Also, we hire people that that are in a socially difficult environment, and we reinsert them, help them reinsert them into society by giving them jobs in our different properties. Obviously, it has its own challenge, but it is something that we have to do. We get the LEED certification, as Michael does, for office properties, and all our office properties are either LEED or BOMA Best certified, and so on. So it is very important, and we know where we're going with this. Most of our office properties being in the province of Quebec, it's easier because obviously we don't use dirty fuel in order to heat or cool our properties. So it's just like natural hydroelectricity. So get points on that basis, but we just have to do more. Last summer, we went, the whole team, we went and we planted trees so in an area in a schoolyard that needed the shade and so on. So it's just like, it's really here, it's employee driven, and it makes a difference, and it's fully endorsed by management, and we participate in all our efforts. But it is prime as far as governance is concerned. 43% of directors, managers here are female. Board level, we're at 33% female. So it's like we're getting to where we should be. Obviously, you can't do this. You can't turn the corner on the nickel on this thing. But we're really focused on, and it's not smoke and mirrors, and I've seen, and Michael has seen, certain organization basically issuing statements about ESG, and all of a sudden you read them and you see that this was just like copied off of some European group. And so it's like you just got to walk the talk, and so it's very hard or difficult in order to translate what you do on an ongoing basis, how you motivate your employees in order to participate, and give you some guidance as to what they want to do, and then it becomes a plan for the organization. but it is definitely here on our head office. We're trying an urban garden this summer for the first time. So we have an urban garden. So in order to have the urban garden, then obviously we had to have the water. So we brought the water to the roof and so on. But it is employee initiatives, and we sponsor them, and we just want to make sure that it makes a statement or a difference. And that's why we walk the talk, and it is very important for us.
Wonderful. And then, you see certainly on the larger side, firms like Granite REIT and a number of others that are able to tap that green bond market. Do you think that this is something that holistically is going to continue to filter down, where you're going to get, access to different capital that you would have been otherwise, discounts on financing from different groups because they want to have that exposure?
You're asking me the question. We're not doing it for that. We're just doing it because it matters. So if eventually it comes to what you're alluding to, fantastic. But we're not doing it for it. That's not our goal.
We've been
Michael, the same thing.
Oh yeah. So what we've been finding is, the green bonds, the discount rate is so tiny. Maybe it's 2 basis points, maybe it's 5, maybe you get a little bit more interest. We're finding a lot more action in the private markets, where we have financial institutions that are committed to achieving certain social goals. And there, maybe we can go from like 62 to 67% debt with no additional rate. Maybe our rate is 10 or 20 basis points less. And you put it all together, we can increase our returns by 30%. So we think there's lots of opportunities. We're with the Canadian Infrastructure Bank, where they loaned us $135 million to decarbonize 18 office buildings and an apartment. And that's a 25-year loan at very low rates. And the cost will be paid for by the savings in energy. So and we're going to reduce carbon emissions by at least 40%. So there are some areas that are really exciting. Again, I think that, so somebody says they have a sustainable bond or a green bond, and it's, 362 instead of 365. I guess it's nice, but it's not like, it doesn't move anything. It's just people decorating, in my opinion.
Agreed. So, kind of one of the last ones, as opposed to, the softball pitch, it's more the heater down the middle. But we have, Toby with CIBT is something that's been somewhat hard, I think, for the general investor to understand. You have both the education side and the real estate side. And then Michael, the same thing with Dream Impact Trust. And you've had a lot of very, very sophisticated capital that wants to partner with you. But on the public side, it's been something more difficult to educate the market of why this should be trading at a different place and why it's so exciting and compelling. How would you characterize your experience as a public entity? Is it something that you go ahead? Sorry,
Toby.
Yo, hi.
Yeah, sorry.
Yeah. For us, it's unlike a REIT with a steady income. Obviously, the downside for us with a real estate development project and being public, it's challenging to meet those quarter-to-quarter expectations, especially for investors who judge a company by its quarterly earnings. So that's one of the downside we see as a public entity and have development projects in our wings. But then for the upside of being public is increased exposure to a broader base of potential investors and with investors for a lower investment threshold. So we have a lower PE. That's how I pitch it. We have a lower PE, lower entry cost means higher upside potential, significant growth, higher dollar value, meaning the economy of scale, and very predictable incomes. So those are the upsides. But obviously, educating the public takes a bit of time, and having a mixed story of a huge education arm and then a construction and development arm, mainly just for our own projects, housing students and working professionals. So that's a bit challenging. Part of our plan is to have that real estate arm spin off somewhere down the road, so that we have an independent, standalone real estate story with our own captive audience. So that's sort of our plan for the next little while to make the story more clear to the investment community.
Wonderful.
Just a comment on the student housing business. That's a great business. It's a higher yielding business. It's steady. It takes a little bit more skill and specialty, but congratulations, Toby. We think that's a great sector to be in and one that you'll be well rewarded for. Our company is really focused on how do we serve both the stakeholders for high returns and the community stakeholders for benefits. And you're absolutely right, Rob. Consistently, we're finding more sponsorship on the private side with joint venture partners or institutions that invest in us than we are on the public side. It's been a funky market over the last while. I think people are looking for things straight down the middle, a lot of index hugging. And our company is a little bit out there. I mean, we're really excited. We're about 50% income, 50% development. We're hoping to get it up to 70% income. And as we have more projects, we had $300 million of new income properties. Some were acquisitions, some were development last year. We think if we keep doing that, people will get it more. But, you know, I think you're right. When you have companies that aren't very, very simple and large and, you know, kind of like just a big apartment REIT, you reduce the number of investors that are going to spend the time on you. So we keep working on it. We've got about $600 million of equity in the company. So we got lots to do with that, but we'd love to see the markets give us value for what we're doing.
Agreed.
If I can just add, it's just that there's a big disconnect between the market and real estate. And a little bit of what Toby said is that real estate is a long-term play and the market is a short-term play. So how do you reconcile both is very difficult, because we all, you know, when we manage our businesses, we think long-term. We don't think about tomorrow morning. We think about in 5 years, 10 years, 15 years, this is going to happen. This is the value of my land. You know, the $30 million that we stand to win over this redevelopment is not, you know, valued in our IFRS. Why? Because it's not a deal yet. It's going to be a deal when it's a deal, when it's firm. So it's not valued. So it's not part of it yet, but we know that eventually we'll, you know, it's going to be part of our valuation. But, you know, we look at the investor, you know, Toby said, you know, it's every quarter. I think it's every day. So every day they look at the ticker and they say, oh, I'm disposing. Okay. Or others are saying I'm buying, but it's on a daily basis. And that's the disconnect that exists between real estate and the market, which is, you know, it's difficult to reconcile. And especially when we're all working, you know, for the good of the organization. Michael said the good of the community as well, which is part and parcel of everything that we do. You know, you look out for your tenants, you have to. You know, the pandemic has shown those that didn't believe in that they had to. So overall, it is a long-term play, and investors have to look at, you know, investing in Michael, investing in Toby, investing in BTB in the way that it's sort of a long-term thing. You know, when you look at the results that we all have, there's no reason why all of a sudden there's been a sale in the, you know, a massive sale in the markets, because we're still producing. And Toby made the reference earlier, you know, every month we're profitable, we produce revenues, we pay out the distribution every single month, no miss. So it's like, is it better than a bond? I don't know, but today, you know, if you were to buy BTBs, close to an 8% return on a tax deferred basis. So I think it's compelling.
Absolutely. We had a panelist this morning that said, how am I going to grow? My assets are worth a lot and people will buy them. And I'm going to buy my peers because I love what they're doing and it's cheaper. You know, there's something to be said for that. We're watching everybody trading well under what their intrinsic value should be. And it's, you know, there's good long-term buying opportunity.
Absolutely.
So I think on that note, I'm going to thank everybody today. We had a wonderful conference, and certainly thanked Michel, Michael, and Toby on this panel. It was wonderful. And thank you everyone that's watching for coming to our Laurentian Real Estate and REITs conference for 2022. I'll leave it over to Fred as well.
Thank you.
Thanks everyone for attending.
Thank you.
We'll see you very, very soon.
Thank you.
Thank you.